Welcome back. Well, let's look back at numbers now. We've discussed stock prices. Let's discuss earnings. Motilal Oswal has come out with an interesting report, which is called A Breath of Fresh Air. So that's exactly the first question to Gautam Dugard, the author of this report. Gautam, good morning. Thank you very much for joining us. What would you say are the main features of the second quarter numbers? Fewer downgrades, more than expected upgrades?
Yeah, hi, good morning. So as we have mentioned in the report, I think this quarter clearly has come as a breath of fresh air for us. We've gotten used to downgrades, numbers missing estimates, aggregate estimates being pulled down. And given that this was the first quarter after GST, one went into this quarter with a lot of trepidation. At the end of the quarter, one can say that the quarter has panned out much better than expectations, at least on the quality of earnings. While the aggregate numbers are still in line with estimates, what really gladdened our heart was that the internals of those numbers were far better than one would have thought. So you mentioned about the upgrades to downgrades. In our universe, we have seen upgrade to downgrade ratio improving from 0.46 to 0.84. The surprise to miss ratio is at a 16-quarter high at 1.3. The third angle is out of the 17 sectors that we track, almost 14 have reported EBITDA which is either in line or ahead of estimates. And lastly, if you look at the number of companies which are reporting YOY decline in earnings in our universe, at 33%, while it is still high in absolute terms, but it is at a 12-quarter low. So I think we are clearly looking at earnings which are growing, and given that the next few quarters and even FY19, we have a benefit of low base, and a lot of the disruptive reforms are now behind, one can clearly look forward to much healthier earnings picture going forward.
Good morning. Actually, that was my follow-up question, because when you're last in the race, you can't fall further behind. You can only look forward. Now with base effect catching up, and we're assuming that in second half as well, we may see double-digit growth. But with that as a favorable base, are the ingredients in place now for us to have a earnings CAGR in double digits over the next 3 or 4 financial years?
We clearly think so that those ingredients are in place. In fact, if you look at this quarter itself, the pace of earnings downgrade itself has come down. So our aggregate estimates have not changed virtually. I mean, we are still at 480 rupees of EPS for FY18 as far as Nifty is concerned, and we are at 600 rupees odd for FY19. So clearly there has been no downgrade in Nifty EPS estimates. Now, let me take you back 8-9 months. We were used to 3-4% kind of a downgrade every quarter after the quarter has passed through. We would have downgraded at an average of 2 to 3% estimate cuts in Nifty. Now last 8-9 months, if you put together, I was looking back at my estimates in Feb, we were at 490 or 495. So there has been hardly 3% cut. So clearly the pace of downgrades as far as Nifty EPS estimate itself are concerned, that has moderated. And I think as far as ingredients are concerned, one of the key takeaway for me for this quarter was the coming back of consumption. So one of the very clear theme which is emerging out of the second quarter result season is that consumption is coming back, and more importantly, rural consumption is coming back. And ingredients for rural consumption are also in place. Inflation has come back, which is always a very positive sign for consumption-oriented companies. We've heard commentaries from consumer companies, auto companies, durable companies. All of them actually pointed towards easing of consumption trends. And as GST settles down, as rural supply chains and in fact even urban wholesale supply chains come back to normalcy, the possibility of consumption surprising on the upside in 2HFY18 is far higher. And I would be betting on rural consumption from that point of view.
That's a really interesting point, Gautam. Morning. And let me dwell on that a little further. So, this consumption recovery has happened without the price cuts that we're now going to see in this quarter and then from here onwards. So what is the volume growth, general volume growth assumption, let's say for staples at least, for the second half? And how might one be best placed to play consumption? Should you be in discretionary? Should you look at restaurant stocks? Should you just stick to staples? You're saying rural, because in rural also has an auto play to it. So how best do you play the cycle?
Yeah. So just to dwell on that point, this quarter out of the 18 consumer companies that we track, 17 of them have reported earnings which are either in line or ahead of our expectations. So I have not seen such a broad-based performance in a long time. Now, how do you play it? the point that you mentioned, the price cuts have come through. Yesterday there were a lot of news reports about some of the consumer companies taking almost 5 to 10% price cuts. So obviously this is going to spur the consumption. So volume growth will pick up. You are used to 4 to 5% kind of a volume growth over the last 2-3 years. Maybe that will move towards 6 to 8%. But what I'm more excited about is the inflation coming back, because price growth always makes a big difference to the bottom line growth. Volume growth cannot go to 12-13% from 5%. It will go to 7-8%. But pricing growth coming back is always far more helpful, and that will straight away flow to the bottom line. So I am looking at a possibility of a double-digit top line growth for a lot of consumer companies in FY19. Now, how do you play it? It has to be a mix of both staple as well as discretionary. There are obviously rural-oriented plays in consumer companies which we have liked for some time. Companies like Britannia, companies like Emami, Dabur, even Hindustan Lever for that matter. Those could be a very obvious play in auto. You can think about M&M. But what is really important is even discretionary is making a big comeback. You have seen volume growth, or for that matter top line growth of discretionary companies, be it Titan, be it modern trade players like Future and Trend, or companies like Jubilant. All of them have reported numbers which are far ahead of expectations. So I think companies like Titan, companies like modern trade players, they remain a structural beneficiary of the reforms that have happened in the last 18 months. For example, on Titan, we are still very bullish. It is one of our top ideas that we've highlighted in our value migration report that we had released in January 2017. It is our structural bet from a next 3 to 5 year point of view. While the stock has doubled in the last 8-10 months, I still feel that there's a lot more juice still left from a next 3 to 5 year point of view, because these are changes which are very big changes, and the shift which is happening from unorganized to organized, be it in case of jewelry, be it in case of adhesives. I mean, these are far exciting sectors today than they were a year and a half back. So there are a whole host of plays to play the consumption theme, and I think that theme is making a comeback after some time.
Really? Yeah, I was just wondering, isn't this what we were pricing in all the while?
Yeah, valuation is a different ballgame altogether. I think valuations can remain expensive once you see the return of volume growth, once you see the return of pricing growth. Last 1 year, 2 years, we have seen valuations sustaining without earnings coming through. Now, if earnings come through, I don't think the prices are going to correct. There will obviously be some period of time correction that can happen, but I will doubt if you are going to see a major price correction given the kind of consumption revival which is on the anvil.
By the way, the mid-cap index is in the red and the Bank Nifty is almost headed there, and Nifty as well is off the high point. So, the call that Ashwini had, that's working, shorting the rally. We'll just get him back as well. But, Gautam, final question from my end. I'm just interested in a couple of, parts, SBI and ICICI and Larsen and Toubro. Is there enough in the earnings to suggest that, good things are around the corner for economy?
See, when earnings are at an inflection point, you always get a lot of doubts on valuation, on earnings. Today, I think, for example, the point you mentioned about corporate banks or PSU-oriented or private-oriented corporate banks, what we are seeing is there is a 1 year clearly a tactical trade which is at play. While from a structural viewpoint, 3 year, 5 year, you will still find retail-oriented private banks, retail-oriented banks outperforming this corporate-oriented banks. But from a next 12 months point of view, I think I won't be surprised if this tactical trade in favor of corporate-oriented banks play out, because there is still a lot of valuation legroom to catch up. And going forward, if you see surprises coming on slippages front, because this quarter the slippages are far better than what one has gotten used to in the last 5-6 quarters, then I think there's clearly some more juice left, even after accounting for the upside that we have seen post the announcement of PSU Bank recapitalization. Coming to L&T, I think clearly the downgrade in terms of the guidance for order book, that was a sore point in the results, but I think margin-wise they have maintained the guidance. Top-line growth-wise they have maintained the guidance, and as you see a increasing sign of capex recovery going forward, which clearly today is not the case, this remains the no-brainer play on that private capex recovery happening going forward.
Okay, Gautam, we'll leave it there today. Thanks a lot for your time today. That's the view from Motilal Oswal. Clearly sensing some green shoots in economy, but the market is now in the red for the mid-cap and the Bank Nifty. The Nifty as well, 8 points only in the green.